While it may seem like a difficult task, there are actually several strategies you can use to build wealth even in times of economic uncertainty. In this video, we'll be sharing 10 actionable steps you can take advantage of a recession and come out of it on top financially. So if you're ready to learn how to make the most of a recession, keep watching. 1. Invest in undervalued stocks. Investing in undervalued stocks or assets refers to purchasing securities or other assets that are trading at a price that is lower than their intrinsic or fundamental value. The idea is to buy these assets at a discount and hold on to them until their value increases, at which point you can sell them for a profit. One strategy for finding undervalued assets is to look for companies or assets that have been affected by negative news or market conditions and are therefore trading at a lower price than they would be otherwise. This is especially relevant during a recession, when many assets may become undervalued due to the overall downturn in the economy. By investing in undervalued assets early on in a recession, you may be able to take advantage of the low prices and potentially earn a higher return on your investment when the market recovers. However, it's important to carefully research and evaluate any investment opportunity, as there are no guarantees in the stock market and there's always a risk of loss. 2. Consider low interest rates. Low interest rates refer to a period of time when the cost of borrowing money is relatively low. When interest rates are low, it can be a good time to refinance your mortgage or borrow money for investments, as the cost of borrowing will be lower. Refinancing a mortgage involves taking out a new loan to pay off an existing mortgage, usually with the goal of obtaining a lower interest rate or more favorable terms. If you can secure a lower interest rate on your mortgage, you may be able to save a significant amount of money over the life of the loan by reducing your monthly payments. Borrowing money for investment refers to taking out a loan in order to purchase securities or other assets with the goal of earning a return on your investment. When interest rates are low, the cost of borrowing money for investments may be lower, which can make it a good time to consider this strategy. However, it's important to carefully consider the risks and potential returns of any investment opportunity, as there are no guarantees in the stock market and there is always a risk of loss. Number 3. Cut down vain expenses. Cutting unnecessary expenses involves identifying and eliminating non-essential spending in order to save money and improve your financial situation. This could involve things like canceling subscriptions or memberships that you no longer use, reducing your spending on entertainment or dining out, or finding ways to save on bills and other household expenses. Building a strong financial foundation involves taking steps to establish a solid base for your long-term financial health. This can include things like developing a budget and sticking to it, paying down debt, saving for emergencies, and setting financial goals for the future. By focusing on building a strong financial foundation, you can create a stronger financial base that will allow you to weather economic challenges and take advantage of opportunities as they arise. This can involve developing good financial habits, such as saving and investing for the future, and making smart financial decisions that support your long-term financial well-being. 4. Consider side hustles. Taking on extra work or side hustles refers to engaging in additional paid work outside of your primary job in order to increase your income. This can involve things like freelance or gig work, starting a small business or selling products or services on the side, or working a part-time job in addition to your full-time job. There are many potential benefits to taking on extra work or side hustles, including the ability to earn additional income to meet your financial goals, the opportunity to gain new skills and experience, and the ability to test out new career paths or business ideas. However, it's important to carefully consider the time and energy required to take on additional work and to make sure that it aligns with your overall financial and career goals. It may also be necessary to manage your time carefully in order to balance your extra work with your other responsibilities. 5. Save on taxes. One way to save on taxes is to contribute to a retirement account, such as a 401k or an IRA, individual retirement account. Contributions to these types of accounts may be tax deductible, which means that you can reduce your taxable income by the amount of your contribution. For example, if you contribute $5,000 to a 401k in a given year and are in the 25% tax bracket, you may be able to reduce your taxable income by $5,000, which could save you $1,250 in taxes, assuming a 25% tax rate. In addition to the potential tax benefits, contributing to a retirement account can also help you save for the future and provide financial security in retirement. However, it's important to carefully consider the specific rules and limitations that apply to these types of accounts, as well as the potential risks and rewards of investing in them. Number 6. Create a versatile portfolio. A diverse investment portfolio refers to a collection of assets that is spread across a variety of different types of investments. The goal of building a diverse portfolio is to spread risk by including a mix of investments that are less likely to all be affected by the same market conditions. For example, a portfolio that includes a mix of stocks, bonds, and cash investments may be less vulnerable to market fluctuations than a portfolio that is heavily concentrated in a single type of investment. By diversifying your portfolio, you may be able to reduce the overall risk of your investments and potentially increase the chances of earning a positive return over the long term. It's important to note that diversification does not guarantee a profit or protect against loss, and it's still possible to experience losses even with a diverse portfolio. However, a diverse portfolio can be an important tool for managing risk and maximizing your chances of success in the market. Number 7. Keep up with the job market. Keeping an eye on the job market means paying attention to economic and industry trends as well as the demand for different types of jobs. By staying informed about the job market, you may be able to identify new opportunities or areas of growth that could be a good fit for your skills and experience. Being ready to pivot to a new career if necessary means being open to the idea of making a change in your career path in order to adapt to changing market conditions or pursue new opportunities. This could involve updating your skills and education, networking, and being proactive about seeking out new job opportunities. While it can be intimidating to consider making a career change, it can also be a way to stay relevant and in demand in a changing job market. By being open to the possibility of pivoting to a new career, you may be able to find new opportunities and achieve long-term career success. 8. Offer help. Recession-proof skills are those that are in high demand and less likely to be impacted by economic downturns. These skills may vary depending on the specific needs of the market, but they could include things like technical expertise, problem-solving abilities, and the ability to adapt to change. By using your recession-proof skills to offer services to businesses struggling in a recession, you may be able to provide value and support to companies that are facing challenging economic conditions. This could involve consulting, freelancing, or offering specialized services that can help businesses navigate the recession and emerge stronger on the other side. It's important to carefully consider the specific needs and goals of the businesses you are working with, as well as the market demand for your services, in order to ensure that you are offering value and positioning yourself for success in a challenging economic environment. Number 9. Unemployment insurance. Take advantage of government programs and benefits, such as unemployment insurance or small business loans. Number 10. Stay up to date with the economy. This can help you make more informed decisions about your money and help you prepare for potential challenges or opportunities that may arise. There are many resources available for staying informed about the economic climate, including news outlets, government reports, and financial advisors. It's important to choose sources that are reliable and provide accurate and relevant information, and to consider a variety of viewpoints in order to get a well-rounded understanding of the economic landscape. By making informed decisions about your finances, you can take a proactive approach to managing your money and positioning yourself for financial success in any economic climate. This may involve developing a budget, saving for the future, reducing debt, and investing wisely. There you have it. By following these secret recession steps and taking advantage of opportunities to save and invest wisely, you can position yourself for financial success during a recession and beyond. Remember to stay informed about the economic climate, cut unnecessary expenses, and build a diverse investment portfolio to protect against market fluctuations. And don't be afraid to pivot to a new career or take on extra work if it aligns with your long-term goals. With a little planning and strategy, you can emerge from a recession stronger and wealthier than ever before. Thanks for watching. We'll see you in the next one.